Thank you so much for joining us, everybody. I'm Jake Alexander from Action Accounting. I can't tell you how much I appreciate you taking some time out of your day to spend time with us and learn a little bit about tax planning here. It means the world to us, and we promise to bring you as much value as possible during our time together today. And so what I always like to do is start with a little bit of housekeeping just to kind of outline exactly how the event's going to work today, because this is the webinar version of Zoom. We do that for a specific purpose. I don't know if any of you have ever been on a Zoom call where more than 4 or 5 people can talk at the same time, but it can instantly go off the rails and turn into utter chaos. And that's the last thing we want for you guys here today, because you are taking time out of your busy day to spend time with us. And so what's going to be really important throughout this is the Q&A box on the bottom. You'll see the little chat icon, just like a regular Zoom meeting, because this one's the webinar version. It also has the Q&A box. And so if you do want to ask a question, we encourage you to ask as many questions as possible. We've got plenty of time built in to the end of this event for Q&A, and we specifically do that for a purpose. What I would request everybody do right now is just so I know you know where that Q&A box is and you know how to use it. If you could just go down there and type in your first name and what city you're from, I think that would be an amazing way just to make sure everybody knows how to utilize the event in the event that you do have a question. And then I always like to know a little bit about where people are joining us from too. So do me a favor, if you're on here already, and I'm sure we'll have plenty of more people jump in throughout the course of the event, just utilize that Q&A box. It should be right down there at the bottom. Type in your first name and type in where you're from. So there we go. We got Molly from Dunedin, right down the street from us. Our corporate office is in Tampa, so I would assume we'll get quite a few of people joining us from Tampa, but that's amazing. Do me a favor, just, use that Q&A box, type in there your first name and type in where you're joining us from. That would be amazing. We got Todd from Wildwood. Thank you so much for joining us today. So I want to make sure everybody knows that. In that same vein, we scheduled this event for an hour. With the content portion of it is typically about 25 to 35 minutes, just depending on how in-depth and technical we want to get in this stuff. What I found from doing these over the course of time is the more interactive it is, the better. And we want to create as much of a good learning environment for you guys as possible. And so what we've also realized is when we do these, we have kind of a mixed bag of different type of people joining these events. And so some of you may already be current tax planning clients that we're working with on some of these strategies. That's amazing. We appreciate you joining. Some of you may be potential clients who have never done tax planning before, and that's great too. We'll occasionally have employees, contractors join these events for training purposes and things like that too. And I say all that to say there's no such thing as a silly question. So if I'm covering one of these topics or you just have a question in general, I would encourage you to type it down in there in the chat. And we got plenty of time built in at the end for Q&A. And so Alan from Dallas, big shout out. Thanks for joining us. Ed from Largo. All right, great. And so if you're just joining us too, do me a favor, that Q&A box down there on the bottom, that's how we'll communicate back and forth through the event. Just type in your first name, type in what city you're from and where you're joining us. And so without further ado, we'll get started. We'll get moving into this thing. And so S Corp strategy is what we're going to talk about. I'm Jake Alexander from Action Accounting, and give you guys a quick overview of just what we're going to talk about today. We're going to cover a lot of information. So like I said, if anything comes up, if you have any questions, you want me to expound on anything, feel free to type it in there into that Q&A box. And we've got plenty of time at the end to make sure we fully cover everything. And if we need any further information, you can always book an appointment with somebody on our team so we make sure we get everything handled for you in every situation possible. And so we're going to do just a quick intro, a little bit about me and Action Accounting. This presentation's not about me, but I always think that's nice, and I'm not some perfect stranger up here talking to you guys. So we'll just do a little bit of a quick introduction of me and our company, which is Action Accounting. A majority of the time, we're going to talk about entity selection. So this right here, we're going to cover some of the main, most popular entities that are out there, specifically LLCs, partnerships, S Corp. We're going to spend a good amount of time talking about that. That's the name of our event today, is S Corp Strategies. And so some of you may already be a business owner who utilizes the S Corp strategy. If so, that's great. You might be a new business owner who's heard of it, but has some questions or aren't as familiar. We're going to cover that pretty in depth here. And so I know you'll get some value out of it. We talked a little bit about C Corps and nonprofits too. From there, we're going to go into advanced strategies. So this is really interesting because, like I was just saying, some of you may already have a very successful business that you operate as an S corporation, and you're looking for some advanced strategies. We want to make sure we have a little bit of something for everybody who's on here. And so we're going to cover some good amount of information for those as well. So really exciting there. And then last but certainly not least, we got Q&A at the end. So save your questions, type them in at the chat as they come up, and we'll make sure we get all those answered and get you taken care of. And so that's going to be the outline of the content for this afternoon of everything we're going to be discussing. Quick introduction on me. Like I said, it's not about me, but I always think it's great that I'm not some perfect stranger up here talking to you guys. Oh, we got somebody from Maui, Hawaii, Travis. That's awesome. Thanks for joining us. And if anybody else has jumped in here too, we just ask, type in your first name, type in where you're from. So A, you know how to utilize the Q&A feature down there at the bottom, but then B, we know who you are. We know where you're from. So a little bit about me. I'm Jake Alexander. Action Accounting is the name of our business. We have three main departments in our company. Bookkeeping, which is important from just an overall compliance standpoint. Anyone who's a business owner understands you got to have your books done prior to year end for us to be able to compile a tax return for you. But what I tell clients is, most importantly, you need proper bookkeeping so you can understand your financial reporting, your P&L and your balance sheet that you're getting every month. You want to utilize those to tell you as much information about your business as possible so you can make good business decisions and drive towards better overall profitability moving forward. And so we have a department in our company, all they do is bookkeeping for business clients. We have a tax preparation team, which all they do is file timely and compliant tax returns. I like to highlight that real quick because there is a major difference between tax preparation and tax planning. Our tax preparation department, the people who work in that department, they're geniuses, they're brilliant, they're great at what they do, but their job is really to give you a timely and compliant tax return based on the information that's already happened in the previous year. What we're doing right now falls a lot more in the tax planning department and tax planning section. As though this is the proactive, forward-thinking, deep dive into your specific situation to come up with proactive strategies on how to save you as much money as possible and how to get you to legally and morally pay the least amount of taxes as possible. And so those are the three departments in our company. Like I said, we're spending some time today in the tax planning department because all of you are here because you want to learn how to save money moving forward and how to be proactive and figure this stuff out. And so if you need help or you need assistance, you can always reach out to anybody on our team at our website, which is actionaccountingusa.com. And then, of course, if you want, you can follow us on all the fancy social media channels there too. And so, well, I want to jump right into it. I always like to start with this quote right here. And so this is a quote from Judge Billings, learned hand, who was a judge of the United States Court of Appeals back in 1934. And so this was an opinion that to this day, almost 100 years later, has never been overruled or never been overturned. And what he said, anyone may so arrange his affairs so that his taxes shall be as low as possible. He's not bound to choose the pattern which best pays the treasury. There's not even a patriotic duty to increase one's taxes. And I love starting with this quote because to me, what this says is that it's okay. It's okay to have a strategy. It's okay to have a plan on a way to pay the least amount of taxes as possible. You're not doing anyone any favors by not having a plan and writing a bigger check to the government than you have to. And for all of you out there that are business owners or anyone who earns income, you work very hard all year long to earn that income. The last thing you want to do is at the end of the year, write a check to the IRS that has to be 1 penny more than it has to be. And so I love starting with this quote right here just to let you guys know this stuff is okay. It's actually encouraged by Congress. And a lot of people ask why, right? So why is the tax code written for business owners? It's because 2/3 of new jobs in the US are created by small businesses. Up to 40% of economic activity is actually attributed to small business. And when you really understand what the IRS is at the crux of them, they're an organization. They're a debt collection agency. They're the biggest, most powerful one in the world, so you don't want to mess with them. But at the end of the day, they're a debt collection agency. Their job is to collect money. And I tell our clients, your job is to minimize the amount that you pay them. And so that's what we love doing, is putting proactive plans in place to help our clients pay as least amount of money as possible. And so if you're on here too, because like I was saying, we do get a good mix of different people. Some people are employees, some people are business owners, first-time business owners, more experienced business owners, if you will, too. So what if you don't own a business and you're just an employee? That's fine. I would tell, my advice would be to maximize all of the employer offered benefits that your employer does offer. And those are things like retirement plan contributions. So if you have a 401k plan, I would encourage you to max it out. A lot of people don't realize you can put up to like $28,000, $29,000 into those retirement plans. Doesn't just have to be the little 3% match or whatever that the company offers. Take advantage of an HSA if it's applicable. You got to have a certain kind of health insurance and it has to make sense. And then if you're earning multiple six figures on a W-2 salary, maybe even look at like a deferred compensation plan if your employer offers that. And so from there, I want to go into entities. And just real quick, I see we had a few more people jump in. We appreciate you. We tell everybody just use the Q&A box there down at the bottom so you know how to use it. If you do have any questions, feel free to type them in there throughout the course of the event. If you're just joining us, type in there your first name and where you're from, where you're joining us from, so we can say hi and shout you out there too. And so, okay, jumping into entities. And so we're going to cover some of the most popular entities out there. Now, there's a lot more than this, but these are probably the most popular ones that we see on a regular basis. And so the first one I want to talk about is a single member LLC. So this is just what it sounds like. It's an LLC that only has one member. And so a lot of people set these up because they're easy to set up. They offer a little bit of asset protection. But what a lot of people don't realize is there's no real tax benefit at the end of the day to setting up a single member LLC. And so the reason is that's a state recognized entity. The IRS doesn't even recognize a single member LLC as an entity. They call it a disregarded entity. So by default, any activity that you have with a single member LLC will automatically get taxed on your personal tax return. And when that happens, you automatically pay 15.3% self-employment tax on all of your earnings. And we don't want that to happen. We want to minimize that as much as possible. And so that's the first one we're going to talk about, the single member LLC. From there, we go to the multi-member LLC. And so just like single member LLC is what it sounds like, the multi-member is very similar as an LLC, but it has multiple members. And so this is an LLC that has more than one owner. We see this a lot of times. I'm not sure why or where it comes from, but for whatever reason, we'll have spouses starting a business where one is mainly involved, one is maybe slightly involved, and they think or have heard from somewhere that making your spouse or your brother a 5% owner of your business is a good strategy to do. I'm not exactly sure where that comes from, but when you do that, a lot of people don't realize is by default, you'll now be taxed as a partnership by the IRS because there's more than one owner. The IRS is going to think this is a partnership. And that's not necessarily a bad thing if that's part of our strategy, but where that gets people in trouble, and we see it quite often, is they'll go creating these multi-member LLCs for some business they just started or to hold their short-term rental property that they own with their brother or cousin or for whatever. And because they put two owners on the LLC, the IRS is now expecting a partnership tax return, which that's a 1065 tax return. It's totally different from your normal 1040 tax return that's due every year. And just because the IRS loves to keep us confused, they actually give you different due dates on them too. And so the partnership tax return is due in March, where your individual tax return that you're used to filing isn't due till April. And so something to be aware of there. When it comes to the multi-member LLCs, only add extra members on there if there's an actual strategy or there's an actual reason, is what we advise our clients. And so from there, we go to the S Corp. And this is where we're going to spend a majority of the time today is talking about that. Now, the S Corp it's a pass-through entity. And this is interesting for several reasons, but the main one is it's a pass-through. So the entity itself, the S Corporation, doesn't actually pay taxes. All of the taxes, all of the profits that the S Corp makes get passed through to the owners on their personal tax returns. And so one of the main benefits is there's a savings on self-employment tax. Like I was telling you guys up here on this single member LLC a minute ago, all of your net profits are going to have that 15.3% self-employment tax on there. When we go to the S Corp, we've got some strategies in place where we can't get rid of it completely, but we're going to highly limit it and get it down as low as possible. One of the common misunderstandings with an S Corp is you just can't go start one because it's not an actual entity itself. It's an election on how to be taxed with the IRS. And so what happens is people will set up a single member LLC or a multi-member LLC or maybe a C Corp. Then what we can do is elect to have it taxed as an S Corp to the IRS. And when we do that, it becomes the pass-through entity. So the entity itself doesn't pay taxes. It all gets passed through to the owner, which can be good for multiple reasons. And then there's that great savings on self-employment tax too. And so in the next slide, I'm going to give you guys an example of how that savings actually works. We're going to break it down a little more in detail. So keep going. We got a C Corp. This is becoming somewhat, I don't want to say phased out. They're still active and still able to be created, but these are becoming less and less popular over the years because of the fact that they're double taxed. So a C corporation, we tell our clients, unless you plan to go public within the next 2 or 3 years, take the company public and put it on the New York Stock Exchange, you have to turn it to a C Corp. Other than that, unless there's some specific strategy or dynamic in place, a lot of times we're gonna push you away from the C Corp because it's double tax. So in that situation, the corporation itself pays taxes. It pays a 21% flat tax on its profits. Then whatever money is paid to the shareholders of it, in that case is called dividends, you as the owner get to pay taxes on that again too. And so that's typically not the situation we strive for. We want you to pay less taxes, not pay more taxes. One of the interesting things with a C Corp, or one of the kind of more advanced strategies we'll see, is if somebody already has a successful business running as an S Corp, we may set up a separate C Corp and have it taxed on a fiscal year. And so what that is your C Corp runs on a normal calendar year. So for accounting purposes, we're counting what happens from January to December and reporting taxes on it. This isn't, like I said, it's a little bit more of an advanced strategy, but we could also set up a separate C Corp that has a fiscal year and say its year ends at the end of October. So what it does is gives us a little 2-month period towards the end of the year where we can do some really interesting income shifting activities and some super tax planning opportunities too. So that's just a little bit about S Corp, C Corp. From there, we have nonprofit, and we do have a lot of clients out there who have these very noble, great causes, who want to help humanity and do all these great things. And if you do, that's amazing. We can help you set up a nonprofit. If you do, we just like to let you know that these are highly scrutinized by the IRS because of misuse. Not that anyone here would ever do anything like that, or we would ever allow our clients to do that. But unfortunately, in that world, there is a lot of different things that happen. And so if you do elect to go nonprofit, just know it is highly scrutinized. It's got to be organized properly, and you've got to do everything by the book. So if you do, it can be an amazing way to help out and give back there. And so that's just a little bit of overview on entities. And I see we had a few more people join in there too. Never to go back to the beginning, but please just utilize that Q&A box down there. If you guys have any questions on what we're covering, feel free to pop them in there throughout the course of the event, and we'll make sure we get all those covered by the end here for you too. So that's a little bit on entities. Moving forward from there. So S Corp strategy. So some of the benefits, like I told you guys, one of, if not the main benefit of being taxed as an S corporation, is the savings on the self-employment tax. And so I wanted to give you guys an example here, but keep it as high level as possible. And so when you have that single member LLC, you automatically pay 15.3% self-employment tax up to the amount of the Social Security limit, which keeps rising, right? Just a few years ago, that was like 117,000. Now it's almost 170, but that's a whole different conversation. So you pay 15.3% up to the Social Security limit. So in this case, if you had a business taxed as a single member LLC and it had 168,000 in net profits, you're automatically going to pay almost $26,000 in self-employment tax. And now that's in addition to your federal income tax. That's just the self-employment tax, which essentially goes towards Social Security and Medicare. In the S Corp example, what we like to do here is we would encourage our clients to take that single member LLC, but elect to have it taxed as an S corporation. And to give you an example right here, what we're going to do, we use $150,000 as an example with the net profit. Without the S election, that's going to equate to $22,000, basically $23,000 in self-employment tax right there. If we have that same entity, same earnings, but we tax it as an S corporation right here, we still have that same 150,000 net profit. But what we do is we mix it up a little bit. We pay 50 of it to you in the form of a salary. We take the other 100 and we pay it to you in the form of distribution. So you're still taking home your same 150K net profit, but that payroll tax number goes down to 7,650 instead of almost 22,000 for an instant tax savings of about $15,000 in that example right there. And so, like I say, and that's one of the biggest benefits of being taxed as an S corporation. But there's a lot of other ones. There's a lot of other fringe benefits too. And so these are things like health insurance premiums. If you elect to be taxed as an S corporation, the premiums you pay for shareholders, health insurance premiums can be tax deductible. So now you're going to have a tax savings on there. Opens you up to retirement plans. So just kind of quick, high level on retirement plans. There's a ton of them out there. If you're already working with a financial planner, that's great. We encourage that and highly recommend it. If you're not currently working with a financial planner, we would love to make a recommendation for you on a retirement plan because that's a big part of the tax planning process. And so just quick high level overview on some retirement plans that are available. The simplest, probably easiest to set up is an individual IRA. They're the easiest to manage and simplest to set up by far. You can put $7,000 into one of those. That's money that's now you're not paying taxes on. It's in a retirement plan growing for you tax-deferred. Once your business is a little bit more successful, you could look at like a SEP IRA, which is short for a simplified employee pension plan. So with those, the limits are much greater. So you can actually put up to $69,000 per year into one of those retirement plans. As your business gets more successful, you might want to look at like a 401k plan. We can add on a profit matching, profit sharing component to it. One of them that's really popular with our clients, and this is for the situation where if you own a business and you and your spouse are the only employees of the business, you can actually look at like a solo 401k plan. And those are really interesting because the limits are $69,000 a piece for each person if the husband and wife are both active in the company. And so that's over $100,000 per year you could be contributing to these retirement plans. That's money that's now a deduction from your business income, and it's in a retirement plan growing tax-free for you over time. So travel expenses, we love helping clients maximize their travel expenses when you convert to being taxed as an S Corp. One of the rules, actually, a lot of people don't know this, is you're actually supposed to have an annual shareholders meeting. And so, don't abuse this, obviously, but we encourage our clients to have their annual shareholders meeting in nice places, right? And so you want to make sure you're maximizing those travel expenses out there. That's just one of them. There's the Augusta rule, which this is kind of a fun one right here. It's actually Internal Revenue Code Section 280A says if you own your home, you can rent it out up to 14 days per year, and the income derived from that activity is actually tax-free to you as the homeowner. So if you own a business, S Corp in particular, your business can rent your home from you for up to 14 times per year. Has to be for a specific business purpose. You have to charge in line with going market rates. But if you do, then that money paid now as rent is a deduction from your business, and it's tax-free income to you as the homeowner. So it's kind of a fun one right there. You can always hire your kids. A lot of people don't realize this. Instead of hiring outside help or just hiring regular employees, you can hire your children to work for you in your business. And so think along the lines, if you were going to hire an office assistant or some sort of staff or some sort of cleaning person to come clean the office, if they're your children, the typical ages for labor laws do not apply. What I tell people here is, don't get too creative. We have clients ask us on occasion, if I put a picture of my 3-year-old on the website, does that constitute as them being an employee? Well, maybe a little bit, but it's not going to constitute paying them the full amount, because what a lot of people don't realize is if you hire your children to work in your business, you can actually pay them a little over $14,000 per year per child, which is money that's now a deduction from your business, and it's tax-free to them as the children. And so they have to perform an actual role in the business, and you have to pay them in line with going market rates. And so I put this here as a little, just a little sort of side note on that one, because if you do have an S corporation and you put your children on the payroll inside of the S Corp, you're still going to pay that Social Security and Medicare, the payroll taxes essentially, which isn't the end of the world. But if you did want to avoid that, you can also set up a separate single member LLC, also known as like a family management LLC, where your S Corp You could pay some marketing fees, maybe some management expenses over to this single member LLC, which could then pay your children the $14,000 a piece per year. That money would be a deduction from the business and then tax free to them. And you would also avoid paying the Social Security and Medicare taxes on there. So that's definitely an exciting one right there if it applies and we utilize it the right way. Home office. Always like to touch on that because home office isn't going to save you millions of dollars in taxes, but every little bit adds up. And as you guys can see, we're going through these here. We're starting to really rack some stuff up. And so the rule with a home office is it has to be a separate area in your home exclusively used for business. If it is, and you qualify for the home office deduction, then we take the square footage of that space divided by the square footage of the entire home, and we come up with what we call a home office use percentage. And then from that point, a lot of people don't realize you can write off that percentage of your utilities, like your electric and your internet. If you're renting the place, then that percentage of your rent. If you own the home, then that percentage of your mortgage interest and real estate taxes. There's all kinds of different things that you can start to be entitled to deduct with the home office deduction. And so that's a good one. As an S Corp, we encourage, if you have employees and they have the need to spend company money, we encourage you to set up what's called an accountable plan, which instead of just getting a company credit card and giving it to sales reps or outside reps or whoever need to buy lunches for clients and basically spend company money for any reason, then you can set up what's called an accountable plan. So this is where instead of you giving them access to company funds to go spend, they have to spend their own money. So they have to basically purchase this with their own personal funds, turn in a receipt to you, and then you can reimburse them. That money is a deduction from the business, and then it is tax-free to them as employees. And it's real interesting. We found over time that employees are a lot less likely to spend their own money and get reimbursed for it than they are to just go out and spend your company's hard-earned money. So interesting fun fact there. So that's a good one. And last but certainly not least, our vehicle expenses. So as an S Corp owner, you can write off your vehicle expenses. Most importantly is Section 179. This is one that we love talking about here. So if you purchase a vehicle and you use it for more than 50% business usage, then it weighs over 6,000 pounds, you could potentially deduct, it's called depreciate, which is basically a fancy word for deduct, up to 60% of the total cost of that vehicle in the first year you buy it. So if you're looking at purchasing like a $50,000 vehicle before the end of the year, and it's purchased for or used for more than 50% of the time for business, and it weighs over 6,000 pounds, we're talking about a potential $30,000 tax deduction that could help you out right there. And so those are just some of the benefits. I want to cover some of the requirements too. As you do convert over and become taxed as an S corporation, there's going to be some requirements, right? It's a lot of benefits, but there's also requirements too. So now we need to file 2 separate tax returns instead of 1. We file a business return, which is 1120S, and an individual return, which is your 1040. The owners need to be on payroll. So this is one that we want to make sure we drive home here. So if you're already taxed as an S corporation or you're thinking about making the switch, the owners need to be on payroll. Please don't try to do this yourself. Please hire a service to process your payroll because it is very tedious just in nature. And we see it all the times where little seemingly small things can go wrong, but it causes all kinds of penalties and interest, notices, and all those kind of things too. So if you need a recommendation on a payroll provider, we'd be glad to make one for you. We've got several different partners that we work with, but that is one of the requirements of being taxed as an S Corp is that the owners need to be on payroll. And so another big part of this is strategically, we want this payroll to be as little as possible. So I don't know if you guys remember a few slides ago, we were showing you the example of that 15.3% gets paid on your salary amount, not on the full amount. So there's some strategy that goes into it there. We want your payroll amount, your actual salary amount as the owner to be as low as possible while still appearing reasonable to the IRS. And that's where the strategy comes in. So another thing to understand about S Corp is distributions at the end of the year for tax purposes must be in line with ownership percentage. And so kind of like I was mentioning in the beginning too, we see a lot of times people add other people as 5% partners on their entities and partnerships and those things for whatever reasons. If you're taxed as an S Corp, whoever's on the ownership documents at whatever percentage, they need to pay taxes on that amount of the company's profits at the end of every year. And so, just as an easy example, if we had an S corporation that showed $500,000 in profits, we had two partners at the end of that year, each partner, if they're 50% owners, are going to pay taxes on $250,000 a piece. You want to know that going into this, because if you do have a situation where, say, you have one majority 70% partner, three other 10% partners, if those people are paying taxes on that money at the end of the year, they're probably going to want to be entitled to it as well. And so just sort of a long-term thing to be aware of is distributions must be in line with ownership percentages. And then last but certainly not least, you must have good, clean records. Once you take the option to be taxed as an S corporation, there's no last minute recreating this stuff. Proper bookkeeping is essential. Just sort of takes you to the next level of taking your business seriously from an organization standpoint, all of which we can help you out with. But we like to tell people up front that if you're going to do that, it's something to be aware of. You want to have good bookkeeping in place so you can be aware of the distributions like I was just talking about, and then managing overall profits and taking advantage of as much stuff as possible. And so a couple of advanced strategies. I'll touch these real quick and then we'll go into the Q&A. I see a couple questions coming in there. One about S Corp distributions. We can cover that. And then distribution to cover partner. Oh, that's a good one too. So let's cover these real quick. I think we're almost to the end of this and then we'll get to the Q&A. So thank you for putting those in. We'll have plenty of time to talk about those here in just a second. So real quick, couple of advanced strategies, because I said I know we've got people from all walks of life over here. Some people just started their business. Some people are doing millions of dollars in revenues in their business, and that's amazing. If you get to a point where you're doing multiple six figures in profit from your S corporation, one of the things we look at is it's called a cost segregation study. And so if there is ever the ability to purchase the building that your business operates in, you want to take advantage of that, and you want to do what's called a cost segregation study. And so without going into great detail, essentially what a cost segregation study does is helps you accelerate the deductions you get for owning commercial real estate. And so just for a quick example, these are rough numbers just to kind of give you guys some context. If you were to buy $1 million commercial building, the IRS lets you write off the amount of the building minus the land. So roughly we say that's like 80%. So you have a cost basis of $800,000 for this commercial building. Typically, what the IRS lets you do is depreciate it over 39 years because that's a commercial building. So what that does is by purchasing this commercial building, essentially gives you a $20,500 tax deduction for the next 39 years. What a cost segregation study does is helps accelerate the depreciation on all of the items that are in that building that can be depreciated or deducted faster. And so for rough numbers, it's usually about 20% of the cost of the building they're able to come up with in these cost segregation studies. And what these are things like furniture inside the building, improvements that are done to it. I've seen them include sidewalks outside the building, those little curbs that are in the parking lot so you don't drive too far forward. They do a study on the building and find all of the items that they can depreciate or deduct faster than the overall 39 years. And it's usually about 20% of the actual cost of the building. And so just doing rough numbers right there, instead of getting that $20,500 deduction over 39 years, you can get $160,000 deduction in your first year and then split up the difference over the rest 38 years. That's great for purchasing buildings that your business operates in. It's also really good for short-term rentals. If we have any Airbnb owners out there or VRBO owners, I would encourage you to look at a cost segregation study. You don't need one as extensive or as legally done as you would on a commercial building. There's some do-it-yourself options out there that we have plenty of those for you. We can make a recommendation, but definitely something to look at there once you're making multiple six figures. Another one is a defined benefit plan. So especially if you're operating as an S Corp and doing multiple six figures in profits per year, this is a defined benefit plan. If you guys remember when we were back talking about retirement plans, I talked about the 401k plan and then the solo 401k plan. The defined benefit plan is kind of like the ultimate next step of a 401k plan. It starts off as a 401k plan. We add a profit sharing component to the 401k plan. Then the ultimate bolt on is what's called this defined benefit plan, which is essentially a really fancy retirement plan for the owners of the business. You can put over $200,000 per year into these plans. That's now money that's a deduction for you off of your business income, and it's growing in this tax deferred account towards your retirement. You do need to use a qualified plan provider, which we can recommend to you. And I don't want to get too technical on that one, but for anyone who's earning multiple six figures in profit in your business, we definitely want to talk about the defined benefit plan. So conclusion, we'll bring this thing in for a landing here, is you really need a tax plan. You need to be proactive. Don't wait until the last minute. Now's the time to take action. I would encourage you guys, we'll answer all these questions and stick around here for as long as you guys have questions, but I would highly encourage you, thank you, first of all, for joining this call and learning a little bit more about taxes in general. But if you have more questions, I would encourage you to book a call with one of our advisors. You can do that by going to our website, which is www.actionaccountingusa.com. Right there on the front page, it says book an appointment. That'll take you directly to our calendars where you can book a call and talk to one of our experts about your specific situation if you prefer to do so in private. And so thank you guys so much. I want to jump into some of these questions here real quick. So Molly asked, can you explain S Corp distributions? How do you take them? So essentially the money you're taking is payroll is going to be run through your payroll provider, right? So that should be getting paid to you on some sort of regular interval, like your weekly or bi-weekly payroll. Excuse me. Your distributions, I try to stay away from the term however you want or whatever you want, but you can really take them however you want. They don't need to be on a regular interval. So ideally, you're doing them once a month or once every other week or on some sort of regular interval, but you can literally just transfer money from the business account to your personal account. The important part is that it gets tracked in your books properly and coded as a distribution and not some sort of other expense or other taxable event or something like that. And so if the question is, how do you take them, as in like, how do you transfer them to your own business bank or from your business bank account to your personal account? You can literally just do an online transfer if they're through the same bank. That's what a lot of our clients do. You can write yourself a check, take it out of one account, deposit it in your personal account, or you can even go withdraw cash if you really wanted to. The important part there is that it's coded in your books as a distribution. So hopefully that answers that question. Another one, distribution to the partners cover their tax. Can the distribution to the partners cover their tax liability without changing that liability? So this is a good one. I think this is referencing back to when we were talking about how distributions from an S corporation need to be in line with ownership percentages. So the amount will always change because by nature, if you're doing a distribution, it makes the taxes go up. We could always help you do a projection on what those taxes are going to be to help it get as close as possible, where if you're paying them an extra $10,000, that's going to incur $2,000 in taxes. So we make the distribution for a total of $12,200 or whatever the number is. So there's not a way to do it without changing it because it's sort of a sliding scale, if you will, but we could help you estimate what that number is going to be, which is what we'll typically do in that situation. Good questions, good questions. Let's see, any advanced strategies for even larger taxable income? Love that question. I would say, I would encourage you, Ed, to set up a call with one of us, and then we could go through some things. There's an endless amount of strategies out there by far, but depending on, how you generate your income, a lot of other situations, the kind of business, some of the personal things you have going on, we would come up with like a more of a customized solution for you. So there are more advanced strategies out there. Absolutely. Just depending on your appetite for some, or if they're a good fit or not, I would say my best recommendation would be to set up a call with somebody. You can go to our website, which is www.actionaccountingusa.com, right there on the home page. Probably even bring it up real quick if we wanted to show you guys, and that would be good for you. But I love that question. So let's see. Currently have an S Corp and looking at bringing on to 10% owners. So here we go. This is a great situation right here. This is sort of in line with what we were talking about. Just to show you guys the website, Like I was saying, if you go to actionaccountingusa.com, you go right here on the front page is book an appointment. I would recommend that for you, Mr. Ed, with the large income question, but great question. We would love to have a conversation about that. So keep it going. Currently have an S Corp and looking at bringing on 10% owners. I had been advised before to establish a holdings LLC above the S Corp and have the shares be distributed there instead of the S Corp. What is your advice? So great question. It depends. It depends on the overall strategy. It depends on what you're trying to do long term. This could be a good way to go, but it could also create more complexity from a tax filing standpoint and from a compliance standpoint. So some of the questions I would have is how long, obviously things can change, but like how long do we expect these 10% partners to stick around? Is this like a 6-month thing for one big project, or is this a longevity thing where you guys plan on working together over the next 10 years to grow and sell the company? So like longevity of how long and what we're actually doing it for would be one of the questions that I would have. And then from there, we could really devise a plan for you. The simplest way would be, of course, just to add them as owners of the current S Corp. We could do that in a pretty simple fashion, but then you have things to think about, like the distributions being in line with ownership percentages like we were talking about, some other liability issues too. So I think something like that, the answer is it depends. Depends on the overall situation and what the long-term goal is, which I think that's probably the biggest thing I would consider is how long are we expecting this to last, and what are we really trying to accomplish past them just being the 10% owners. So not trying to be vague, but there's some dynamics to that one that we would need. So I'd encourage you book a call with one of us. We can hash it out though, if that doesn't answer your question. So those are good, great questions. If anybody has any more, type them in the chat there. If not, thank you so much for joining. We really appreciate it. I'll stick on for a few more minutes here. If anyone has any more questions, we'd be happy to answer those. If not, thank you so much for joining. We will send a recording of this out to everybody who joined and the people who registered and missed it. So that way you can ever watch it again or listen to it if you're ever in bed and can't sleep for whatever reason and need something to knock you out. But no, thank you guys so much for taking time out of your day. We really appreciate it. If you do have any questions, pop them in there. We had booked until 3 o'clock for this, so I'll stick on for a few more minutes there and answer, and we'll go from there. I always jokingly say if nobody does have any questions, that means because I covered everything so accurately and succinctly that nobody could possibly have any questions. So I'll take that as a compliment. Oh, we got another one. Peter here said, I got a call when you answered the distribution covers partners tax. Okay, so the question was, if you want to pay someone more distributions to cover the taxes owed on said distributions, is there a way to do that without causing more taxes? The easy answer is no. But what we can do is help you estimate what those taxes are going to be. It's based on that person's personal situation and the tax bracket that they fall in. So for an easy example, if they're taxed in the highest tax bracket of 37%, whatever you're going to pay them $10,000 in distributions, essentially $3,700 in taxes that they're going to have to pay. So we would raise the distribution to, we could do the actual calculation off the top of my head, say 14,500 to then cover the taxes owed plus the difference in the 37% and the increased amount. So short answer is no. We could help you run a calculation. We do that quite often for people in that situation. And that's why I put that in here. In the webinars, we get a lot of people who don't realize that, and they end up having to pay taxes on money that they either never received because it was reinvested back into the business, or all kinds of different crazy situations can happen. So you're welcome. Hopefully that answers. And so I can't remember exactly. I can't remember the name of who asked it, but was asking about, since we have a few minutes here, if you guys don't have questions, I love talking about stuff. I could talk about it. I could talk about it for hours, but one of the advanced strategies for higher income earners that it really becomes applicable around the end of the year. We have partnerships with companies who will take charitable donations in the form of ways that can compensate the person who donates in a very advantageous form. And so one of them is a company that and I'm not on the technical side of what they do, I'm not extremely versed, but they create medical kits that are used for victims, like burn victims. And so it's a company who actually creates these medical kits, and it does something fantastic that like helps people regenerate their skin after they get burned in fires and those sort of things. And so they run a seed round of funding, not every year, but typically at the end of every year, where you can make a donation to this company. And when you make the donation, you actually get credit for, we're donating at the cost of these medical kits, which is X, but you actually get credit for a charitable contribution of Y, which is the fair market value of these donations. And so like for easy numbers, we were running this last year. It was a $50,000 contribution to this charitable cause, got you in return a $250,000 charitable deduction, which if you're a high earning taxpayer, more than likely you're in the 37% tax bracket. And so 250,000 times 37% was a $92,000 tax savings on your $50,000 charitable contribution. And so those are some things that come around towards the end of each year. That's one in the charitable contribution space. We've got others in the oil and gas space, which will, not to get too technical, but have somewhat of a similar concept where you're investing money at X, but getting credit for Y, which is much higher. In oil and gas, it's called intangible drilling costs, which is likened to depreciation on vehicles. It's probably the easiest way to explain it. And so with those investments in these oil and gas companies, you're getting a return on your investment while also strategically receiving a tax saving benefit for the intangible drilling costs, which are the depreciation expenses that come back on there. So if you're earning, if you're in the highest tax bracket, basically, if you're in 37% tax bracket, those are the things that we'll start to strategically look at in combination with all the strategies I listed out here too. So that's what's really neat about the process, is that everyone's situation is so different that every plan is different. And so I would encourage you, I can't remember who it was, and hopefully you're still on here to be able to hear that, but I encourage you to set up a call. I'd love to hash a few things out with you. So all right, we got 10 more minutes budgeted here. So if you guys have questions, I will stick around. If not, I'm going to grab a sip of water real quick. So if you have any questions, type them in the chat. If not, we'll wrap this up here in another minute or two. So. Here's a good one. Here's a bigger question. Off-topic question. Does this LOC, short for line of credit, sound like a scam? 0% interest for 18 months with a 2% to principal per month. They want me to pay for a bond first of 18,500 for a 650K line. Just wondering if this is even possible with interest rates the way they are right now. It seems too good to be true. Company offering the LOC is blank. I don't know how to tell if they are just going to keep the money and never fund me, or if this is an actual deal. Great question. So not necessarily tax related, but I am going to, I don't know if you guys can see the chat, but I'm just going to highlight this part right here that says seems too good to be true. And in our world, whenever you hear seems too good to be true, Doesn't necessarily mean that it's false or that it's a scam or whatever, but I would definitely do your due diligence on there. And so is the line of credit on your house or on a certain piece of property, or they're just offering you a 650K business line or something like that? So that would be my first question. And then the second one is, it sounds like they're charging, so they're calling it a bond, but is that an actual bond that you can receive back after a period of time, or is that a fee that they're charging to establish the line? So questions would be, is this a line of credit on your house or a piece of property or that you own, or this is like an uncollateralized loan that they're offering you with a very large fee up front? Good question, though. I like that. If you want to answer that, great. If not, it's totally fine too. But that would be it. Always do due diligence on any kind of stuff like that. It's a BLOC, unsecured business line of credit, unsecured. So, I've never heard of 0% for 18 months. I've heard of 0% for a period of time, 12 months, 18 months, 2% to principal per month. So you got to be making payments. The part that's a little weird is the 18.5, I would say. So them asking you to pay that, I would see if that could be added to the balance of the line of credit. Say, sure, I'll give you that, but can you add it to the balance of the line of credit on the back end? Would be ideal, and see what they say. So, but I've never personally heard of that exact situation. My advice, always do due diligence on that stuff. But thank you for the question. Great, thank you. Well, guys, this was so good. I had a great time. Hopefully you did too. I'm going to go ahead, and unless anybody has any other questions, pop them in there. We do have a few more minutes budgeted, but if not, I'm going to go ahead and cut it short here. I do want to tell you thank you so much for joining in. Thank you for the questions. I enjoy this stuff. Like I said, I can talk about this stuff for hours and hours. So if you do have another question, pop it in there. If not, obviously, if you showed up to this one, you'll be on our list for the next one. We do these about once a month, and we are going to start having special guests and that sort of thing on there too. So if you are able to join, be on the lookout for the emails. Check our website for updates. If there's no more questions, I'm going to cut it short. Thank you guys so much. I'm Jake Alexander with Action Accounting. I will talk to you all soon.